It is 9:30 in the morning, August 1st, 2012. A Wednesday, somewhere in Jersey City, New Jersey, a software engineer arrives at his desk with a coffee. His screens are green, his systems are running. The market just opened, everything is completely perfectly fine. 45 minutes later, his company will be dead. And the thing that killed it, the actual cause, was a single line of code that nobody had touched in 9 years. Nobody deleted it, nobody noticed it, it just waited. This is the story of Knight Capital Group, and it is the most expensive software mistake in human history. Most people have never heard of Knight Capital, that's the point. They operated in the invisible layer of the financial system, the infrastructure that sits between you clicking buy and the trade actually happening. They were a market maker. Here's what that means. When you want to sell a stock and someone else wants to buy it, those two things don't happen instantly. There needs to be someone in the middle, willing to buy from you right now, willing to sell to the next person right now, absorbing the gap between the two. That someone was Knight Capital. They made their money on the spread, the difference between what they paid and what they charged. Fractions of a cent, but fractions of a cent multiplied by enough trades become real money. And Knight Capital did enough trades. Every single day they executed $20 billion in trades, not a month, not a year, a day. By 2012, they were the largest retail market maker in America. 11% of all equity trading in the United States passed through their systems. If you bought a stock in 2012, there was a reasonable chance Knight Capital was on the other side. Invisible. Silent, essential, their weapon was technology. Algorithms that could analyze prices, execute orders, and manage risk in microseconds, millionths of a second. Speed no human can match. Speed no human can monitor. The heart of this technology was a system called SMARS, the Smart Market Access Routing System. SMARS took large orders and broke them into smaller pieces, distributing them across exchanges to get the best price with the least disruption. It had been running for years, battle-tested. Knight Capital had built all of this over 17 years, 1,500 employees, $1 billion market cap. One of the most technically respected firms on Wall Street. And then the New York Stock Exchange announced something called the Retail Liquidity Program. The RLP was designed to give ordinary investors a slightly better price when they traded. A good idea, a reasonable policy, but the NYSE gave firms a deadline, 6 weeks. 6 weeks to write, test, and deploy new code into systems that executed $20 billion in trades every day. Knight Capital's engineers got to work. They were modifying SMARS. Specifically, they needed to add a new flag, a tiny piece of code that would mark certain orders as coming from the RLP and route them correctly. Here's where the first problem appeared. And it was small, the kind of small that kills companies. SMARS used what engineers call a flag word, a row of binary switches that tell the system how to handle each order. Every switch was taken. The flag word was full, so an engineer did what engineers do under deadline pressure. They looked for a switch that wasn't being used. They found one. It was labeled Power Peg. Power Peg was an old trading strategy. A system designed to aggressively buy a stock, relentlessly, without limit, until a target position was reached. Knight Capital had stopped using Power Peg in 2003, 9 years earlier. The code was still there, nobody had deleted it. The switch had been repurposed over the years, Power Peg had effectively been disconnected, dormant, forgotten. The engineer reused the Power Peg switch for the new RLP code. Connected the new system to it. What they didn't see, what nobody saw, was that the old Power Peg code was still connected to that same switch. Both systems, one switch. The new code went through review. It passed every automated test. Everything looked correct because it was correct, on 7 of their 8 servers. On July 27th, 5 days before launch, the operations team began deploying the new code to Knight Capital's 8 SMARS servers. The process was manual. An engineer would remotely connect to each server, copy the new software, update the configuration. One by one, 8 servers, 8 updates. But that day, one server was down for maintenance. When the deployment script tried to connect to it, the connection was rejected. The script didn't stop. The script didn't raise an error. The script just moved on, reported success at the end. 7 servers had the new code. Server number 8 did not. Server 8 still had the old Power Peg code, still had the old switch assignment. The team ran 3 days of testing in limited mode. They caught nothing, because in limited volume, the rogue server's behavior wasn't obvious enough to detect. On August 1st, 2012, the New York Stock Exchange opened the Retail Liquidity Program. And server number 8 woke up. 9:30 a.m., market open, retail orders begin flowing into SMARS. SMARS distributes them across 8 servers. 7 servers handle them correctly. Server 8 reads every single one as a Power Peg instruction. And Power Peg's job, its only job, the thing it was built to do, was to buy, aggressively, continuously, without limit. So when an order came in for 100 shares of Molecorp, server 8 didn't fill that 100-share order and move on. It started buying Molecorp. And buying, and buying, and buying. But here is what made it catastrophic. SMARS's normal execution logic was also running. The system was receiving confirmations of its own buys and trying to close those positions by selling. So server 8 was buying aggressively, pushing the price up, and then immediately selling to close the position. Except it was selling at a loss, because it was buying high and selling low. Because it was the machine that was moving the price in the first place, and then doing it again, and again, and again, 60 times per minute across 154 different stocks. Simultaneously, inside Knight Capital the phone started ringing, other firms were seeing the movements, stocks with no reason to move were spiking and crashing. In some names, Knight Capital was responsible for 50% of all trading volume in the entire market. At 9:34 a.m., 4 minutes in, clients were calling the trading desk. The trading desk didn't know what was happening. At 9:58 a.m., 28 minutes in, the NYSE called Knight Capital directly. Knight Capital told them they were looking into it. They were. But they couldn't find it because 7 of 8 servers were working perfectly. The rogue server was hidden in the traffic. Before the market even opened that morning, SMARS had generated 97 automated error alerts. 97. Nobody acted on them, not because they were incompetent. Because in a system processing $20 billion a day, error alerts are noise. They happen constantly. You triage them, you assess them. On this morning, at this moment, the 97 alerts were not assessed fast enough. At 10:00 a.m., 30 minutes in, the engineers finally understood the scale. The positions were in the billions. The losses were hundreds of millions per minute. They started shutting down servers, but they didn't know which server was the problem. So they shut them down in the wrong order. And as each correct server went dark, more orders hit the rogue server. The losses accelerated. At 10:15 a.m., 45 minutes after the market opened, someone finally found server 8. Pulled the kill switch. The trading stopped. The damage did not. When Knight Capital's engineers sat down to calculate what had happened in those 45 minutes, the number that came back was almost impossible to believe. 4 million executions. 397 million shares traded. $7.65 billion in unwanted positions. And a loss when those positions were unwound of $440 million in 45 minutes. Knight Capital had approximately $365 million in cash reserves. The loss was larger than the company itself. In 2 trading days, the stock fell 75%. The CEO spent the night of August 1st calling every major firm on Wall Street. He needed $400 million by morning or Knight Capital was finished. A rescue consortium came together. $400 million arrived on August 5th. The price was the company. The new investors received 60% of Knight Capital's equity. The people who had built it over 17 years no longer controlled it. In 2013, Knight Capital merged with GATCO. The name disappeared. 17 years, 1,500 people. $20 billion a day. Gone because one server missed a software update. Here is what I want you to understand about this story. There was no fraud, there was no greed, there was no villain. What there was a series of very small decisions made by very ordinary people under very ordinary pressures. An engineer who reused a switch because the deadline was 6 weeks away, and the flag word was full. An operations team who wrote a deployment script that failed silently, because nobody thought to test what happens when a server connection is rejected. A server that was down for maintenance and nobody updated manually afterward. A monitoring system that generated 97 warnings, and a human team that didn't escalate them fast enough. None of these decisions looks catastrophic in isolation. Each one looks reasonable. Each one looks like something you would do. Together, they were a chain. And every link held until the one moment when they all failed simultaneously. The Knight Capital story is taught in software engineering schools, in risk management programs, in regulatory training rooms around the world. It has become the definition of cascade failure, how catastrophe can emerge not from evil but from ordinary. But here is the part that never quite makes it into those case studies. 1,500 people worked at Knight Capital, not executives, not decision makers, ordinary people, engineers, traders. Admin staff, people with mortgages, children, retirement accounts invested in company stock. By the time the stock had fallen 75%, the financial damage to those employees, people who had nothing to do with the deployment, who showed up to work that Wednesday expecting a normal day, was enormous. The engineers who made the decisions that led to this were not villains. They were people doing their jobs under deadline pressure in a complex system with imperfect information. The same conditions that produce brilliant software also produce catastrophic bugs. The same speed that makes high-frequency trading profitable also makes high-frequency disasters possible. And this is the part that should stay with you. After the Knight Capital disaster, regulators pushed for stronger requirements. Kill switches, circuit breakers, better testing procedures. Some were implemented. In 2022, 10 years later, a study found that the frequency of flash crashes and algorithmic trading disasters had not meaningfully decreased. The lesson was learned. And then mostly forgotten. Because the pressures that produce night capital, speed, competition, short deadlines, the temptation to reuse old code, the normalization of error alerts, are not unique to night capital. They are the conditions under which every technology company operates every single day. Night capital is gone, the code is gone, the company is gone, the 17 years are gone. The conditions that created it are still here. Somewhere right now in a trading system, in a hospital network, in a power grid, there is a 9-year-old line of code that nobody deleted. Connected to a switch that an engineer reused on a deadline, waiting for exactly the wrong combination of circumstances to wake up. If this changed how you think about technology, subscribe. There are a lot more stories like this one, and I'll see you in the next video.